All right, hello, Sonoma County. Are you 62 years old or almost 62 years old? I have got the most amazing loan opportunity to talk about today. I can barely hold my excitement. I just think this is the coolest product. If you're thinking about making a move, selling that family home, maybe downsizing, looking for the single story, moving closer to the kids, maybe wanting to move into a retirement community like we have Oakmont here in Sonoma County, this could be the ticket to making your retirement, not just surviving retirement, but thriving in retirement. So stay tuned, but let me introduce myself. If you're new to the channel, I'm Julie Sullivan with Sullivan Group Real Estate, and we help people move in and out and all around Sonoma County and Oakmont every year. So if you are thinking of making a move, take a listen to what this amazing loan program is all about and reach out. We'd love to get a plan in place and set you up for success. So you can purchase your new home with one large down payment and not make any more monthly payments ever for as long as you own and live in that home. I know, what? Is it too good to be true? Nope, it's true. And this is not a reverse mortgage, okay? It has some similarities, but I think it's better, and I'm gonna tell you why. Okay, let me give you an example of a couple who used this loan product. They sold their home they were living in. They walked away with $500,000 in proceeds. They thought they were going to turn around and buy a home with cash because this next home they just really did not want a mortgage. It was going to help ease up their retirement income and really make life nice, okay? In the area that they were living, the home they wanted, we quickly realized, was going to cost $600,000. So, there was a lot of debate. Do they just try and settle for something $500,000 or less? Do they take out a $100,000 mortgage? And we learned about this loan program where they can make this one down payment and then never make a monthly payment. So how it works is they figure your down payment using three different metrics. One is your age, the second is the price of your home, and the third are the current interest rates. So the down payment amounts do fluctuate a little bit as interest rates go up and down and do what they do. And then of course, the older you are, the less you put down because they do base this off of life expectancy, which makes sense. So in most cases, you're gonna put down 50 to 70% of the value of your home. So this is meant to be for, said retirees. You have to be over 62. You've sold a home. The money can come from a home sale, from savings or assets, inheritance or gift funds. You cannot borrow the money from somewhere else to use this home loan. That's the only thing you can't do. Money can come just about from anywhere else. So in their case, to purchase a $600,000 home, which they did not have the funds to pay cash for, their down payment amount was $378,000. Okay, they put the rest of the money in the bank. They just pocketed $375 for let's call it $125,000. Whereas if they bought a $500,000 home for cash, they would have used all of those proceeds. So here they could put it in the bank, they can invest it, maybe buy some new furniture, do some retirement traveling, just really kind of opens up the world by not draining all of those proceeds. Once you own the home, the interest that you would accrue on what you still owe on the home does accrue on the back end, but you never have to pay it until you sell the home or you pass away. So I think a couple of things to note on all of this is here in Sonoma County, we always almost see an increase in home values year over year. And even next year in 2026, it is going to be a little more modest is the prediction, but it's still going to be like 4 to 6%. So in general, your home is going to increase in value about the same as your loan is accruing. So when you go to sell the home, you just pay off that balance and the rest of the money is yours again. You can use the program again and again and again. It's not a one-time thing. You just pay off your balance each time when the home sells. And think of it this way as well. If this couple, the example I just used, bought the $600,000 home, put their $500,000 down, okay, used all of that money that they walked away with from their previous home sale, took out a $100,000 loan. By the time they paid off that $100,000 loan, they would have paid almost $300,000 in interest. So you're going to pay it one way or the other. And this way, it's just a smarter use of your money. And it's just the way these loans work. And they may not have ever even paid off the whole thing, and they may have sold the home, but then they would have still paid as much interest as they're accruing on the home and not having to pay for it up front. Okay, so it's kind of a cool way to look at it. A commonly asked question is, what if what I owe is more than what the home is worth? Here's a little fun fact about this loan. This loan was actually created back in 2009. It is an FHA insured and government-backed loan. Congress passed it into existence in 2009. And probably 99% of realtors and lenders out there don't know about it or utilize this product. It is starting to gain more attention as home prices keep increasing. It's becoming a much more viable way for people to enjoy their retirement years and not feel so strapped or house poor, as we say. So the answer to the question of what if I owe more than what my house is worth, you or your heirs are never responsible for more than what the current value is. The FHA insurance will pay off the rest. Now, what's qualification on this program? Everyone always wants to know that. Like I already said, you have to be 62 and older. If it's a couple and one is older than the other, they're always going to use the younger of the couple's age. Again, because of life expectancy. If one in the couple is under 62, you can still utilize the program. They just won't be on the loan, but they will be on title, okay? So there are ins and outs and little ways that we can make it work in a bunch of different scenarios. So you gotta be 62 and older. It has to be your primary residence. This can't be used for second homes, vacation homes, investment properties, etc. There is no prepayment penalty and there is no minimum or maximum purchase price. I mean, come on. It can be a single family home or a PUD. If it is a condo, it has to be an FHA approved condo because it is an FHA insured and backed loan. They don't check credit scores. They don't care. You're not making a mortgage payment. They don't check income and they don't check income to debt ratio. So if any of those are not great, or you're self-employed, or you always have some scenario where it makes it hard for you to get a traditional mortgage, this could be a great option. They will just verify that you do have income and enough income to pay that, because you will still be responsible for the taxes, insurance, and any home maintenance. Make sure there's a little room for home maintenance projects that are going to happen when you own a home, because they are depending on you to keep that home in a decent condition so it can be sold. That's all they verify. So it's very easy. The qualification is very easy and can really help folks that maybe cannot always qualify for traditional financing. If this sparks any interest, please reach out. My phone number is right here. We always answer. You can call, text, shoot me a message right here on this YouTube channel. We'd love to tell you more about it, make this happen for you, help your retirement years just be so much more fun and not stressful. And quite honestly, maybe you'll just find that it's just a smarter use of your money and having more control over that money and then doing what you want with it and investing with it. So I look forward to talking to you all more about this. I can't wait to get you all on this path. We'll talk soon. Bye-bye.